Good evening, everyone. On behalf of Hyderabad Chartered Accountants Society, I welcome you all to today's virtual session on key precautionary measures in GST for year-end compliance and new financial year readiness. As we approach the financial year end, understanding key GST precautions becomes essential for professionals and businesses. We are privileged to have with us CA Manimaran Kathiresan, an expert in GST and indirect taxation, who will guide us through this important topic today. It's our honor today to introduce speaker CA Manimaran Kathiresan. He qualified as a chartered accountant in 2012 and started his professional practice in 2013, founding his firm K. Manimaran and Co. He is also a qualified lawyer and has completed several professional certifications from ICAI in different areas such as indirect taxations, congruent audit of banks, forensic accounting and fraud detection, and non-profit organizations. He holds a diploma in information system audit and is currently pursuing a PhD in GST from Oxford University, Hyderabad. He has extensive experience in GST, customs, and foreign trade policy, and regularly represents matters before appellant authorities and tribunals. He is the founder of GST India Daily, an education platform dedicated to simplifying taxation concepts for professionals and students. With this brief introduction, I now invite Sir to share his insights on today's topic. Over to you, sir.
Thank you very much. Thanks for giving me an opportunity. So this is my first time for taking classes for Hyderabad Chartered Accountants Society. I thank all the management and the members for giving me this opportunity. And we'll start with my presentations. Bye. So, thank you. So this is related to year-end compliances. So now we are in month of March, and everyone is related to closure of our books of accounts. We usually close the books of account by seeing the TDS and by seeing the books of account provisions and whatever the depreciation needs to be passed. So that we usually do. And when the GST has come, so after that, we used to do the reconciliation part as well and ITC reconciliation part. So without this, if we are closing our books of account, then we are definitely receiving a lot of notices. Since the books of accounts and our GST returns mostly will not match. Why? Because in our books of accounts, many things we are not reported in the GST. If it is related to interest income or dividend income, so these are all incomes we usually reported in our books of account while going through the 26 AS, and we used to compute what is the interest on capital and we'll book in the year end by closing our books of account. But we forgot to report the same in our books, in our GSTR 1 as well as GSTR 9. So it leads to the issue of notices, and it says the difference between the turnover which is reflected in GSTR 1 and reflected in GSTR 9. And for the year 17, 18, 18, 19, 19, 20, we used to receive a lot of notices related to ITC. So which ITC? We have a books of accounts and we have an input tax credit in the ledger. However, the reflection of ITC in 2A, it was not there. So everyone received a lot of notices for the year 17, 18, 18, 19, 19, 20, even 21, 22. So for those years also, we still receiving these notices. And we need the precautionary measures before closure of books of account, and we should inform our clients. So these are all problems, and we may receive notices because of these issues. So it always helps us for our practitioners, and definitely we can close accordingly. And out of which I have, there is an introduction part. So why year-end GST review is critical. So the first one, section 16, subsection 4, time limit for availing the ITC. So we know everyone, section 16 is talks about conditions to avail input tax credit. We know that the basic 4 conditions required. So the first one is we should have a tax invoices. and it should be received, whatever it is, goods or services, it should be received in the place of supplier, means whoever running the business. So it be a place of business, they should receive the goods or they should receive the services. And third one, the vendor should file the return. And fourth one, the vendor should pay the tax. So these are all four basic conditions we used to verify. And though all the four conditions are there, but when we are availing those input tax credit after this 16 subsection 4, whether we are available to avail those same, no, because whenever we are reaching the time limit, so crossing the time limit to avail the ITC, then those ITC will be lapsed. So what is the condition says? Section 16 subsection 4 says the input tax credit should be availed before 30th November of the following financial year or a date of filing of annual return. Some of the companies has been filed their annual return when they released. So as and when they released the GST-9 and 9C form. Some of the companies they filed even before June and July itself after completion of their income tax, even before completion of their income tax audit also. So by the time, if they have missed any input tax credit and whether they can able to avail, no, it is not possible because what they are saying that here, whichever is earlier. So we can avail before 30th of November or date of filing of annual return, which is GST 9 and 9C. So what we have to do while before finalization of our books of account, we should go through all the GSTR 2A and 2B, and we should verify is there any input tax credit still not availed in our GSTR 3B return. Why this will happen? Because the GSTR 2A, we know whenever the vendor has been filed, it is a dynamic form. It is immediately reflected once your vendor has been filed. But if you take it's a GSTR 2B returns, that also we know it is a static report. If our vendor has been filed within the due date, then only it reflects, otherwise it will not be reflected. So we should go through what are all GSTR 2A and whether it has been matched with our books of account. So the purchase, whatever we have, and whether we availed those input tax credit in our books of account, that we should verify. If anything has been missed out, and we can avail at least before finalization of books of account to avail those ITs. Why there is a time limit for availing? See, here in the GST, we have a only time limit for availing and not for utilization. For avail of ITC, we have a time limit. Is there any time limit for utilization? No. There were no time limit for the utilization. So once you avail and it will be reflected in your credit ledger, then you can utilize n number of years unless until it will be lapsed. So the people will ask some other question. Sir, I actually availed input tax credit. However, I have reversed due to the goods has not been received or I have not paid amount to the vendor more than 180 days. So what happens? I availed in the month of May and after September, I have reversed whatever the credit which I have availed since I didn't pay to my vendor or the customer has not filed the return or maybe the goods has not been received. Once you reverse those input tax credit, is there any limit to reclaim those ITC? Whether the 16 subsection 4 is still applicable for whatever we availed and reversed those ITC? No, it is not applicable for those ITCs. It is available, these conditions restricts only the first time availment of input tax credit. Once you have availed and if you have reversed in the temporary reversal, In this GST portal, there's a separate report called whatever the reversal of input tax credit in a temporary basis, it will be accumulated. So whenever you are going to reclaim those, it will be adjusted from this, whatever you already reversed in a temporary manner. So here, whenever you are filing your GST or 3B return in the part 4, in this 4B, 1 and 2, the first one is a permanent reversal and the second one is temporary reversal. So whenever you are going to do for temporary reversal, what is meant by temporary reversal? Sir, my vendor has been filed the return in this month, but my goods has not been received. However, it will be received definitely in the month of next month or subsequent month. Then we can reverse temporarily and we can avail whenever the goods received. But if you have bought some motor vehicle and it is ineligible ITC under section 17 subsection 5, shall I do temporary reversal? No. So once it is a black credit and you should reverse the permanent reversal. If you have done in permanent reversal, that reversal amount will not be accumulated in this GST portal. So this 16 subsection 4, it is availed, it is restricted only for the first time availment of input tax credit and does not affect the availed and after reversal. So once you avail and reverse, and then for reclaim of input tax credit, this 16 subsection 4 will not restricted for this time limit. So this is the first one. We should always check in our financials and books of account and before finalization of our financials account. And the second one is, which is very complicated, the rule 42 and rule 43. We know what is rule 42 and rule 43 also. But whether we are applying, whether our client has been applied properly, that we should identify. What is rule 42 says? We know very well. The rule 42 says the goods which is exclusively used for exempted supply, we should reverse 100%. And if it is exclusively used for taxable supply, then we can avail 100%. Is there any common credit? And we should identify what all comes under the common credit. Once it comes under the common credit, then the rule 42 will apply to that extent of exempted turnover. And the balance taxable turnover we can avail. We can avail as eligible input tax credit. But some of them has asked a question. The person is running a grocery shop and this guy is purchasing vegetables, fruits, and not only that, even grocery item also. He has purchased many exempted item and he has also purchased taxable item. Here for him, whether this rule 42 and 43 will be applicable, we should verify if he is purchasing exempted item and he is selling same under exempted item, then there were no reversal of ITC is required since whatever he purchased is already exempted and there were no ITC involvement and he sold also the same exempted item. And whatever he purchased is a taxable item, he paid tax as well as he is also collected tax from the customer. So here, this is called exclusively taxable supply. And whatever the exempted item is called exclusively exempted supply. In this case, the rule 42 will not apply. But many of the customers receiving from the department, the notice says that you have exempted supply. However, you have availed all the input tax credit without reversal of proportionate basis for your exempted turnover. We should identify whether is there any common credit. If you go there in the grocery shop, the only one common credit will be there, which will be a rental amount. Apart from that, they don't have much common credit. If you go any shop, the bigger shop or bigger grocery mart, whatever it is, they have a another set of common credit like marketing charges, labor supply, and auditing services, advertisements, and rental. So these are all, it comes under the common credit. So for these common credit alone, they should reverse the input tax credit and not for entire taxable items. And what about Rule 43? If they are using computer and if you are using any furniture or air conditioner, this is also used in the common input. And they are using for both exempted and the taxable item. Then we should reverse according to Rule 43. So the problem is people are reversing every month and whether they are calculating in a yearly basis. So the Rule 42 and Rule 43, what it says, whatever the common credit reversal on every month, and we should also work out for the annual, so year end. And in the year end, we should work out the entire Rule 42 and Rule 43 reversal amount, and we should check whether the reversal amount which we have done is short or it is excess. If it is short, then we should again do the reversal while we'll computing the annual in the year end, even for Rule 43. So whether our client has applied this Rule 42 and Rule 43 on a yearly basis also we should identify. And if they have not applied, we should recommend them to do that and we should check whether they have reversed in the yearly basis or not. So if the provisional reversal is excess, an adjustment definitely we should be made. So before finalization of books of account. And apart from that, the reconciliation before closure of books, we definitely reconcile our books of account with GSTR1. So what the turnover which is available in our books of account, it means the profit and loss account says, and whether all the figures has been matched with our GSTR1. In most of the cases, and the department also giving or continuously using notices related to the GSTR1 with books only for the other income cases. And we usually gives the sales amount as per books of account GSTR1 is properly. We used to reconcile the sales amount which is reflected in our books of account, which means profit and loss account and GSTR1 and with GSTR3B, we used to verify. It is properly matched. It may be exempted turnover or taxable turnover, maybe 5% or 18% or 28%, whatever it may be. We used to reconcile. Whether we are reconciling the other income part. So we have a sales revenue or sale of services, whatever we declare. And the next part is other income. Under which other income, whether we are reconciling with GST return. We cannot omit this other income because the other income, whatever they have declared, it may not all the income is exempted. Maybe interest income will be exempted. Maybe dividend income will be exempted. But if it is scrap sales are there and it was disclosed as a miscellaneous income in this books of account, then we should pay the tax. It may GST attract. And is there any profit on sale of assets or profit on sale of motor vehicle? It may affect GST. And the GST levy may levy for these kind of profits. So whether we should check the GST will be leviable for those income or not. And most of them, they are receiving discount income or some other income like commission income or services income or job work income. So those incomes they have received as other income. However, they never checked with whether this has been reported in GSTR1 as well as GSTR3B. If they have not reported, then they should pay the tax amount. So this has to be verified in the books of account. The main category is called other income. And even our sales income, if you take sales income, they have properly disclosed taxable income. But however, they never properly disclose the exempted income. The people say, sir, this only exempted now, sir. We can update it next month or fourth month or fifth month. But that is also income. And the department will send a notice and they said, these are all exempted income you have sold, but you have not yet reported properly. If you check your ledger balances and you have month of from April to September, you have a exempted turnover. However, you reported only in the month of November. You have not reported from April to October. Yeah, it is a procedural lapse. That is okay. But if they are doing either continuously basis, then that may be a problem. So we should educate them. Even exempted turnover, they should declare on a monthly basis. So whether they are declaring interest income or dividend income, that is different part. But in sales turnover, whether they are declaring properly even exempted turnover. And some cases, most of them, the export turnover or SEZ turnover, they're declaring as a exempted turnover in GSTR 3B. In GSTR 1, yes, exactly, they will give SEZ turnover or it is export turnover, and we can use to verify all the things. But once you come to GSTR 3B return, instead of they are saying as zero rated, they actually declare as export exempted turnover. So if they are declaring as exempted turnover instead of export turnover, then the problem will come. The ITC, they should reverse it. So when we are declaring as a zero rated turnover, then yes, exactly we can avail the input tax credit. However, when they declare as an exempted turnover, then we should reverse the input tax credit which is available to the extent of exempted turnover. So the department will send the notice, you have this much exempted turnover, but you have not yet reversed the input tax credit. And apart from that, e-invoice data and with GSTR1. So whether e-invoices is available for all the invoices which we have raised. And likewise, we can also verify with e-waybill data along with outward supply. So these are all we should verify before closure of our sales. And the litigation exposure from audit trail. So the thing is, invoice modifications was there. Or is there any backdated entries? Or is there any deletion of records? Which may affect the GST data, and the department when they are coming for inspection or investigation, they used to check these are all, and they used to check from your tally software or tally data or whatever accounting software which you are using, and they can track what are all modification you have done and what are all backdated entries you made it, and is there any deletion of records, so which may definitely leads to a litigation part. So these are all we have to verify, and we should have a proper audit trial for this. So that AI-driven GST scrutiny is already done by the department people. So the department is using AI and AI tool towards to verify the income tax data along with GST data. And they are also verifying with e-invoice portal and e-waybill portal. They will also check from TDS and TCS information which is available in the income tax as well as GST. In GST also, we are collecting, the department will collect TDS and as well as TCS. So whenever you are doing transaction in e-commerce business, and the e-commerce people will actually collect TCS, and they used to check whatever the TCS amount they collected and you have reported properly. If you have not properly reported in GSTR 3B, that is also a problem. Because in GSTR 3B, they have given exact table to declare what are all sales through e-commerce portal. And we should properly declare these are all sales, which is through e-commerce portal. And these are all sales, which is not from the e-commerce portal. So that we should properly declare. If any mismatch between this, and they used to check with the TCS amount, and they used to verify. So this much sales is done through TCS. However, you have declared only this much, and there is a difference. You should give the report, and they may send the sometime demand notice also. And they also used to verify from TDS. Even TDS also same thing will be happening. So this AI-driven scrutiny, GST scrutiny is happening. So for the finalization, we should verify is there any TDS or TCS, and is there any income tax data, any interest income they have reported in this 26 ASs, what are all income they have received, is there any TDS received for this? So we should verify, and we have to report accordingly in GST portal. So the risk area identified by the department, the first one is GSTR 3B with GSTR 1 mismatch. The GSTR 1, whatever the sales we declared in GST, it should be matched with the GSTR 3B. I have declared for 2 crores of sales in the month of April, then I should pay for the 2 crores of sales. If you made any mistakes in GSTR 1, then definitely you should amend this at least by next month. Nowadays, we have amendment possible in GSTR 1A in a month itself. But previously, it was not available. Whatever we have declared in GSTR 1, and we can modify or we can amend only by the next month. It means subsequent month we can do it. But now, if you have reported wrongly in GSTR 1, you can do effect within the month itself. Because most of the time, the articles people will filing the GSTR 1, and they are entering instead of 1 lakh, they enter extra 10. They added extra 10, then it becomes 10 lakhs of sales. Once it becomes 10 lakhs of sales, then 18% of GST, then it comes to 1,80,000 is the GST amount. But we may not verify whether the sales value properly given as 1 lakh or 1 lakh, 10 lakh. But in GST 3B, when we are filing, what we will do, actual sales, what we have in our Excel sheet, that we will put it, and we used to pay whatever sales. So for 1 lakh only we pay for 18,000, and we file the return. But the department people will reconcile what date, what sales you have given in GSTR 1 and what is available in GSTR 3B, and there is a difference amount of 9 lakh, they will send a notice. They said that you have given 10 lakh of sales, but the sales which is paid only for 1 lakh, for 9 lakhs you didn't pay. Sir, is it possible? Yes. Sometime the accountant also will do these mistakes. And sometime if we are filing in our own office, some article assistant also may give some mistakes. So we should verify whether all the GSTR 1 sales properly declared in GSTR 3B and whether they have paid properly. And there was an incorrect tax liability is always possible. The suppression of sales, definitely they do not give in GSTR 1. And sometime what they will do instead of B2B, they declare in B2C sales. So if they have declared B2B, but instead of B2B, they declare in B2C sales, and after that they want to modify or they want to amend, then they will give extra in additional sales in GSTR 1. Because of that, the GST liability will be increasing. Because the B2C sales, they never given the credit note. They never pass on the credit note, or they never adjust those sales in the next month. That also leads to the tax liability increase. So before finalization, and we should verify every month GSTR 1 sales match with the GSTR 3B, and also it matches with our books of account. And ITC mismatch. In GSTR 2B with books, so the problem here in our books of account, most of the people we used to verify GSTR 2B in that Excel sheet we are downloading, out of which we are verifying whether it is eligible or ineligible. And whatever eligible ITC we are availing and ineligible ITC we are reversing. So this we are doing properly. But most of the cases, the company people will enter input tax credit only for the actual purchases they made. They never made input tax credit entry for the expenses they have incurred. If they are giving money for the courier, see, it means they are availing the courier services. The courier services people will raise tax invoices and they will file their return and it auto-populated in GST or 2B and we also avail. But if you go through in their books of account, the courier charges will be there, but they never segregate what is the input tax credit for this. But the thing is, they already availed those ITC in the GST or 2B. So here the double benefit the assessee is availing. One is from the income tax as well as another one is from the input tax credit. And likewise, not only for courier, if you take bank charges, in bank charges also those people, they never make a entry. Likewise, many things are there. So if it is ineligible ITC, that's not a problem. Sir, it is only for insurance and it is for medical insurance or group insurance or life insurance and it is for motor vehicle insurance. Okay, that's not an issue because it's already ineligible ITC. They can book as a full expenses in their head itself. That's not a problem. But if they are taking insurance for the supply of goods, or if they are taking insurance for the stock, or if they are taking insurance for the building, it is Pakka eligible ITC. So once it becomes eligible ITC, then they should actually segregate what input tax credit is charged for this. But what the company is doing, they properly availed those input tax credit in the GST 2B and 3B as well. According to GST 2B, they availed in GST 3B. But whether they are accounting those input tax credit in their books of account, that is not done. They usually do for the purchases, but they never do for the expenses head. So we should verify whether all the expenses they segregated those input tax credit. Otherwise, there is a double benefit they are availing according to Income Tax Act as well as GST. So that we should verify. So whether the ITC recorded in this books of account is there or not, we should verify. And third one is ineligible ITC. So here the ineligible ITC we know. Mostly we maximum reverse all those input tax credit which is available for personal uses or club membership fees or construction of immovable property or any motor vehicle. But in this some cases, the motor vehicle, once we see this motor vehicle itself, we are declaring that is the reversal of input tax, not by us, by the accountant. So the some of the accountant, they may not aware whether the motor vehicle used for transportation of goods is available. So what we used to check with the accountant, the motor vehicle which they have purchased, whether it is a transportation of goods or transportation of passenger, and even for transportation of passenger, whether it is below 13 or more than 13. So if it is a public transport, still the company is available for those input tax credit. So, and this for motor vehicle alone, we used to ask them to give their tax invoices and we can verify whether it is available or not. And sometimes they are the company or the manufacturing company is purchasing forklift or some of the vehicle which is used in this factory itself. Whether it is eligible ITC, yes, of course it is eligible ITC and they can claim. So it treated as a plant and machinery which is used in the factory and it is used for moving from one place to another place for the transportation of goods and other things. So the motor vehicle, we cannot blindly say it is ineligible ITC. We should verify whether it is transportation of goods or transportation of passengers. And even for transportation of passenger, whether it is a non-public transport, then we can, okay. And how do we identify personal consumption? If you take some of the proprietary concern, they used to give their GST number in the Amazon portal. And whatever they are buying, then all the expenses will be recorded here. Suppose if they are buying dress materials and if they are buying any luxury item, or if they are buying phone, mobile phone or laptop, any kind of items, if they are purchasing from the Amazon or Flipkart, and then everything is recorded in the 2B. And we should identify whether it is eligible and whether it is for personal use or business use, that we used to verify. And once we used to verify, then we can reverse all those input tax credit. So the 17 subsection 5, we should definitely apply at least once in a year before finalization of audit. Because the accountant may not know in all the category which is listed in section 17 subsection 5. They may know maybe one or two conditions or three conditions or four conditions, but definitely they may not know entire condition which is available in 17 subsection 5. So we always used to verify this 17 subsection 5 at least once in a year. And then if any input tax credit which is availed by them, then we should reverse it. If it is ineligible ITC, if they have availed in this year itself, at least we can ask them to reverse in the year itself. And e-invoice with e-payable with GST return. So it is whatever the invoices they raise and whether it's matched with e-payable and whether it's matched with the GST returns. Because whatever the e-invoices they filed in the e-invoice portal, we can download from GSTR1 and it is auto-populated in GSTR1 itself. Likewise, e-payable, whatever they have raised through e-payable portal, that is also we can download from the GST return itself. We can compare what is the sales given in e-invoice portal and e-payable portal and whether it is matched with the GSTR1, we should verify. Mostly, whatever the e-payable raised, suppose say for example, in the month of May, I have raised for e-payable maybe or 1 crore of sales. And my GSTR1 sales, definitely it will be more, not less. Because the e-payable, it will not be applicable for all. It is applicable only for more than 1 lakh whenever I am transferring from sales. Okay. So whenever I am raising the invoices for more than 1 lakh, then only e-payable is going to be applied in Tamil Nadu. And according to GST Act, it's only 50,000. So if you are selling for 50,000 or 30,000 or 40,000, then we never raise e-payable. So you should go through what is the e-payable total sales they declared, whether it is more than in GSTR1 or less. That is a flag, that is a red flag, it is available to us and we can verify. And likewise, even in e-invoice portal also. In e-invoice portal, we can verify what is the sales we declared in e-invoice portal and we should verify with our GSTR1 whether it is matched or not. And is there any unreported supplies, then we can ask them, the clients, why they have not reported and is there any real cancellation of sales or any system failure. For example, they raised e-payable, however, the breakdown of their vehicle and they raised again one more e-payable. So this may be happen, but we should check whether it is happen or not, or they are just like that unreported, the source supplies. And refund scrutiny cases, say usually the department will check whenever we are applying for the refund or in maybe a inverted duty refund. And they used to check whether you have a ITC eligible, either eligible ITC. And if you are availing any ineligible ITC as a refund. So that they used to check. And you have to give a proper documentations and turnover declaration, everything we should properly given while filing the refund of GST. So this is a turnover against lesson. We know turnover against lesson. Yes, we used to do on every year. And when we are filing for GST on 9 and 9C, yes, we used to verify all the cases. However, there is a special attention that alone we will use to check. So credit note issued after March, that we should verify. So whether the credit note, which is belongs to the financial year April 25 to March 2026, if I am raising the credit note in the month of June 2026, can I raise along with the GST amount? If I am raising along with the GST amount, whether I am eligible to reduce my tax liability? Yes, it is available. Under section 34, it says, if you are raising your credit note before 30th of November or date of filing of annual return, yes, it is very much possible. But if you are raising the credit note for the financial year 24-25, whether it is eligible, no, it is already done. The 30th November 2025 is a due date. Then what we can do? You can do financial credit note. That is, any time is allowed. You cannot reverse those the tax liability. Say for example, if you want to give some credit note pertains to the sales 24-25 and the customer asking discount, then you are giving for 1 lakh rupees. If you are giving 1 lakh rupees, straight away is 1 lakh rupees as a financial credit note and in which there were no GST liability will attract. Say for example, if you have sold for 10 lakhs of value, whatever they paid 18 percentage for 10 lakhs, it is 1 lakh 80,000 you already paid for the tax amount. Those 1 lakh 80,000 will not reduce if you have sending the financial credit note. But the same sales will happen in the April 25 to March 2026. Say example, if you have sold the sale for September 2025 is a 10 lakhs rupees and your customer is asking for some discount and it is a post sale discount related to some predetermined or predefinition of some agreement. That is whatever it is. And you are giving in the month of June since they achieved the target. So you are giving 1 lakh of discount amount. When you are raising the 1 lakh of discount amount in month of June 2026, you can reduce the whatever the GST liability which you have paid for the 10 lakh. So to that extent of 1 lakh, you can raise along with the GST amount. So the thing is, whenever we are raising the credit note in the next financial year, we should reconcile with the current financial year, how many credit note we raise in the next financial year and whether all the credit note we have declared in our GSTR1. If they have not declared in GSTR1, then your sales amount will not match with your books of account. So we should identify what are all credit note which we have raised after the March. And if you have raised after the March, then we should check all the credit note which has been reported in your GSTR1. If it is not there, then we should report immediately. And these advances received. So these advances received, mostly the client will not tell at all. What they will do? They will declare everything, this advance amount in sundry credit, sundry debtors itself, in their name itself. And they never mention advances received from customer. So if you go through the sundry debtors, and most of the cases, the credit balances will be available. If it is a service industry, we should ask, sir, these are all advances money you received from this person, whether it is advance money or you already raised the tax invoices. If you have already raised the tax invoices, why still it is credit balance? Whether those invoices have you declared in your GSTR1? No, sir, they have not raised the tax invoices. Fine. Then whether this advance amount has paid tax. So whatever advances received from the customer, they should report in GSTR1 and for which they have to pay the tax. So here the problem is they never mention advance received from the customer and also they never mention about this history to us while going for audit. So better we should check with sundry debtors balance or we can also verify is there any advance amount received or we can also check is there any loan amount they may consider as advances as well loans and for which they have not raised any tax invoices and better ask them to pay and we can get it whether it is if it suppose those advance amount received for goods then that's not an issue and because there were no GST levy for those advance amount it is applicable only for the services. So we should always verify whether those advances GST has been paid. And this unbilled revenue. If the unbilled revenue, we know very well whether the unbilled revenue, whether GST will be applicable, no. So what we will do, the GSTR1, we never show these are all unbilled revenues will be available. It is only our books of account is like adjustment entry, like what we are doing for closing stock. So same thing we are going to do for the unbilled revenue. But from the GST perspective, whether the liability arises based on time of supply, we should verify. So what is the time of supply? Section 12 and section 13 says, section 12 for time of supply of goods. It clearly mentions when the movement of goods is done from your place to customer place, then you should raise the tax invoices. This is for goods. The section 12 of GST Act says. And if it is services, within 30 days from the date of service rendered, they should raise the tax invoices. So when they have declared as an unbilled revenue, whether it is already done or it's still under process, we should verify. If it is still process, that's not a problem. Fine. If it is already done, then we should ask them to raise the tax invoices according to time of supply under the GST Act. So this also we need to verify. And is there any deemed supply? So what is that deemed supply? Suppose you have that assessee has 2 or 3 branches and all the branches not in the same state. They have a different state, different GST registration number. So from one GST branch or from one state to another state, they are transferring goods from one place to another place. Then obviously they should pay the tax. So because it is called the interstate supply, even if it is within the same concern, because the same PAN number and same company and their own branches there in Chennai and as well as Hyderabad. From Chennai to Hyderabad, if they are sending any material or any raw material, any finished goods for the sale or transfer, whatever it is, once it's transferred from Chennai to Hyderabad, then it becomes interstate sales. So once it becomes interstate sales, then they should pay the GST amount. We cannot say that, sir, this is only branch transfer. But suppose if the branch transfers happen within the state, my branch is in Tamil Nadu and my another branch also is within the Tamil Nadu. From Chennai to Madurai, I am transferring goods. Whether GST I need to pay? No. It is not. There were no requirement to pay GST amount because it's only transfer. Then here also same transfer only, no? Yes, here also same transfer, but it's a distinction of business. So we should pay tax for the GST amount. So what we need to verify, so these kind of conditions we know, but that whether the accountant know, we should check. So what we have to verify in their books of account, is there any transfer of goods or transfer of services from one state to another branch? So one branch to another branch, if it is there, then we should ask them whether you have paid GST amount for which. If they have not paid, better ask them to pay. And the related party transaction. So this section 15 and rule 28 clearly mention, is there any related party transactions? We should apply rule 28. So the rule 28 says open market value or value of similar supply. The thing is, when the transactions between related party, the party may influence their value. So if they are selling for 1,000 rupees in the market, and because of the person is related, they can sell even 700 rupees or 600 rupees. That much possibilities will have. So when they are doing the transaction for related party, we know very well who is the related party for this company, and we also used to report in the notes to accounts. In the notes to accounts, what we used to give, these are all related party, and for them, these are all transaction has been made. It means these are all sales made and these are all purchases made, and we used to report in the notes to accounts. And we also should check what value, what transactional value they done and what transactional value they paid the tax. So whether it is less than the market value, which is they are doing for other customer, and the same value they are doing for the related party or not. And then we also check. And now the department is used to send notices even for this case also. So previously the department has not been verified these items, and now we in Tamil Nadu we are used to receive the transactional value difference for related party transactions. So now they are issuing notices even here also. And this one is most important, RCM liability. The problem is that those people will not properly declare or will not properly declare the expenses head in the profit and loss account. So we should verify, is there any goods transport agent services are there? Whatever the GTA they used to maintain, sir, it is conveyance. If they are maintaining as a conveyance, or instead of a transport expenses or transport charges or goods transport agent, then the reverse charge mechanism we may not apply. So we used to ask them whether do you have any GTA services? You are receiving any GTA services? And most of the accountant, they used to book. There were no freight forward or freight inward. They never mentioned. They used to book everything in the local conveyance and conveyance charges because they don't know what is this. And likewise for legal services, they used to maintain only as a professional charges. We know for professional charges there were no RCM will be applicable, right? So the RCM will be applicable only for the legal and who was done by the advocate. And if any chartered accountant is doing, or if any other professionals is doing services, and for which we are not going to pay under reverse charge mechanism. But the accountant people, what they will do, even legal fees also they will declare as a professional charges. If they book as a professional charges, we never know whether RCM will come or not. So we should ask them, is there any legal services availed during the year? And likewise, director remuneration. The director remuneration, what we have to verify whether the remuneration have filed under section 192B or they have filed 194J. Sometimes the accountant may given a wrong TDS. Instead of 192, he may given 194. If he has given 194J, then the reverse charge mechanism will be applicable. And he said, sorry, sir, I don't know which section has to be applied. That is why I have given 194. Otherwise, I will give 192. So this will also will happen because these guy only two directors are there, and these two directors will be working for the company. And for this people, the company is giving monthly salary. So monthly salary means he may take 2 lakhs in the monthly basis. However, for 2 lakhs, he used to deduct TDS only by 1.194J, then the RCM will come. Because for consultancy, the consultancy services provided by the directors, then reverse charge mechanism will be applicable. Then the company has to pay GST under reverse charge mechanism for those. So we should verify under which section they have filed. And really it is a consultancy, then that's not a problem. Then we can pay reverse charge GST under reverse charge mechanism. And import of services. The import of services also, those people will never open their mouth. And we used to check whether is there any import of services. How do we verify? We can verify only through the whatever, is there any foreign payment made? And is there any license they have purchased? Or is there any royalty they have paid? Or is there any purchases they made from the outside India? And while going through the vendor cases, and we can verify what is the company name. Sir, it is related to goods, then there is no problem at all because they have a bill of shipping bill and bill of lading, and it comes to the custom frontier, then there were no problem. So everything comes under the statute. But when they are availing the services, we don't know. And there were no custom frontier for this. We can verify only through whether they made any foreign payment to party. If they made any foreign payment to the vendor, and for what purpose they made, that we should ask them. And is the service category. Then if it comes under the service category, then we should pay GST under reverse charge mechanism. So the RCM liability is a crucial part, and we have to go through the ledger review, under which ledger review we come to know these are all RCM liability will be coming or not. And now most of the time rental also. The rental, what happens? So many people, they are getting rental from warehouses, and those warehouse people, they never register under the GST Act, and they are receiving the rental services from those guys. These are all company. They already register under the GST Act. And whether they have to pay under reverse charge mechanism, obviously, because it is a commercial. Even though commercial property, if he has not registered, then we should pay under reverse charge mechanism and we should avail those ITC. So in rental, we should check whether all the rental account, whether they are collecting GST, or if they have not yet collected GST, then we should check whether they paid under reverse charge mechanism. If they are not paid, then they should pay GST for even rental amount also. Likewise for security services. If the security services made, and security services by any proprietary concern or partnership firm, and the security services provided by the partnership firm or proprietary concern to the corporate, The corporate should pay under reverse charge mechanism, though these people already registered. So these people are not eligible to collect GST under forward charge mechanism. So the reverse charge mechanism, that notification number 13/2017 clearly says, if the person, the supplier of security people, if they are a proprietary concern or partnership firm and they should supply services to the corporate, then corporate has to pay under reverse charge mechanism. So we should check whether this guy corporate or this guy proprietary or a partnership firm. If he is a proprietor or a partnership firm, then we should tell them, so you do not collect any GST, we should pay under a charge mechanism. So for security services also, we should check. And most of the cases, people are paying, that company people, the accountant people, wrongly paying for unnecessarily for manpower supply and facility management supply and professional charges. Whether they have to pay for these services? No. Sir, if any facility management services given, we are availing services, facility management or garden maintenance or manpower, labor supply. So these people, they have not registered under the GST Act. Okay, fine. What is the problem? Sir, we are availing the services now, sir. So, but they have not yet registered. Okay. So, why you have to pay under overcharge mechanism? Is there any section 13? Is there any notification 13 has given the specified services? No. It is not comes under the notified services. Then why you are worrying about that? You don't want to pay any tax. But still those people paying. No, sir, for safer side we are paying. So that's not required. So likewise for professional charges, the people, some of the GST practitioner are those people, what they will do, they are availing this company availing services from them, or some of the directors, they are already retired director and he has given some consultancy services, and for him the company is paying the GST under RCM, but he is not director itself, he is just a professional or some ex-employee of the company. So for him, whether this RCM will be applicable? No. For him, RCM will not come. So we should check, we should tell them or we should educate them, whatever the notification number 13/2017 is there, this alone will be applicable. So these people will do what they will do, they will pay for unnecessary and they will not pay for necessary. And these company, they usually pay GTA only for whatever are reflected in GSTR 2A, and they never pay for whatever the transport charges availed from the GTA. So, sir, it is only reflected, sir. Those people only given this, those people only filed in GSTR1. So for them, I have paid. Whether this amount and whatever you have declared in freight charges in your profit and loss account will be matched? No. So your freight charges will be a huge amount. You have given for 2 crores, but if you take full amount which is reflected in your GSTR 2A, it comes to meagerly maybe 20 lakhs. So 2 crores, out of 2 crores, you have paid only for 20 lakhs. So balance 1 crore 80 lakhs, you didn't pay any GST amount. So we should ask them, GTA, for GTA, have you paid for entire GTA services availed, or you availed, or you paid only for the only as per the GSTR 2A, because most of the company, they are following GSTR 2A or 2B, which is reflected in. Otherwise, they never pay those services. So here the problem comes. So better we used to check these are all legal services or GTA services, whether they paid or not. So likewise, in the input tax credit. So these are all output tax. So whatever the liability we should pay. And here the input tax. There is a ITC reconciliation. Here also some special attention is there. So what we have to follow? There is a missing ITC follow. What is missing ITC? In company, what they will do, whatever as per to be, see, suppose the accountant or the chartered accountant, we are filing for some of the assessing. And what we used to give, GSTR 2B, we will download in Excel and we will share it with them. And we used to say, sir, please check with your actual purchases. And they said, yes, sir, okay, sir, we will do it, sir. So they never do the reconciliation. And when they are in the year end, the 2B, which is not matched with their actual purchases, which is available in the books of account. So most of the vendor, they have not filed their GSTR1 and they have not paid the tax amount. So which reflects the losing of revenue. So we should tell them, follow up with your supplier and ask them to amend their GSTR1 and give the GSTR1. So give their CSTR sales. So this we used to educate our assessee. So we should verify whether your purchases, whatever made from the vendor, those people have filed their GSTR1 and 3B. If they have not filed GSTR1 and 3B, then those input tax credit, it's lapsed because the ITC, there is a deadline. So we should avail before 30th November 2026. If the assessee has not filed the return after the before the 30th November 2026, whether the ITC is eligible, no, we cannot. We cannot avail those input tax credit because it is already lapsed. And time limit check. So that's we already discussed. So the time limit is the 30th November or date of filing of annual return, whichever is earlier. So before annual return or 30th November of subsequent financial year, the assessee has to avail those input tax credit. If anything missed out, that's all. Then the input tax credit will be lapsed. They cannot claim those input tax credit and the amount which whatever they have paid, the revenue loss for them. Then ineligible ITC. So the ineligible ITC, yes, it is very important. We already discussed about motor vehicle, and we also has to discuss about works contract. So the works contract, what happened? The company, they actually given for any works contract to the engineer or any architect, that's not a problem. They will issue only single invoices, and that single invoices will be for as a works contract services, and maybe a 2 crores or 1 crore, and whatever the 18 lakhs will be paid to that amount, we can directly reverse. But this company is availing only labor supply from those company, and this company has already bought all the material which is relevant for those contract, and he has bought cement, steel, and likewise if he is purchasing so cement, steel, paint, and electrical goods and whatever it is. If it is related to construction of a building or construction of factory set or construction of immovable property, then it is a blocked credit only. So we cannot claim this as input tax credit. So the 17 subsection 5 is clearly mentioned. It is related to capital goods and this is related to movable property. Sorry, immovable property. So if it is related to immovable property, then it comes under the 17 subsection 5. But suppose the works contract, whatever they received, they themselves as a contractor, then for them it is eligible ITC. We cannot say, sir, 17 subsection 5, it is a block credit, you cannot claim. But in Tamil Nadu, we have received a lot of notices likewise only. So they are a construction contractor and they are doing works contract for the company. They are executing only a works contract and they are paying 18% of GST, whatever they collected from the customer. But they received the notices from the department and says that you have purchased these are all items which is relevant to the construction of immovable property. It is ineligible ITC under section 17 subsection 5. So it means block credit. You should reverse it. Then we have given the reply that the company the company's nature of business itself is a works contract and 17 subsection 5 is a clearly given exemption for them and they are very much eligible for those ITC. Because of this, they can avail this input tax credit and they can adjust for their GST liability. And for personal expenses, yes, personal expenses, as I mentioned, the company has purchased TV and the company has purchased fridge or washing machine. However, they availed input tax credit in their input tax credit. Whether it is eligible? No, actually it is not eligible. Suppose the company is actually using those items in their guest house or they are using in office itself. It's very much eligible ITC. However, if they are using for personal expenses, likewise, they are using for their home, then we cannot claim. So we always check whether these items which is available in the office or not. And capital goods used for exempted supply. If any capital goods and which is used exclusively for exempted supply, then those capital goods we should reverse 100%. We should reverse 100% if it is used for exempted supply. If it is used for taxable supply, then obviously we can claim. And construction ITC issue, so it is only for the real estate sector. So real estate sector means you people know very well, and the construction contracts are there. So construction contract now, the real estate promoter or residential real estate promoter, we can say REP and RREP. For them, the company will collect only 1% of GST or 5% of GST. For 1% of GST and 5% of GST, whatever they collected from the customer, the company will not be eligible to avail input tax credit. They should reverse it. So they avail the ITC and they should reverse the entire amount because they are supplying those supply of services under concessional rate is 1% or 5%. So they are not eligible to avail the input tax credit for which. So though they are a construction company, and whatever the purchases they made, though it is eligible ITC for them, because of they are paying under concessional rate, they are restricted to use input tax credit. And even though 17 subsection blocked credit, it does not restrict them, but still the notification of GST rate is restricted to avail the ITC. So hence the construction company cannot avail the input tax credit. And again, Rule 42 and Rule 43, this working common credit. So what are all maximum it comes under the common credit? This rental and professional fees, electricity, mostly now GST will not come, and software and administrative cost, and likewise labor supply or advertisement. So those are all used for a common purpose. We cannot say this labor only for the exempted supply and this labor is only for the taxable supply. We cannot say because those people may be in exempted item, may be working in exempted item or may be working in the taxable item. So those people will work entire places. And likewise for advertisement, we cannot say, no, sir, we never do advertisement for taxable item. We only do exempted item. So we cannot say like this. So these are all common expenses, common credit. We should reverse under Rule 42. So every month they have to do, but whether the company or the accountant will do this reversal of credit on a monthly basis, they never do because they don't know what to do and how to do. So they don't know what to do and how to do. Otherwise, if those people sometimes do for entire amount, and the calculation may not identify how to verify or how to check. What they will do sometime, both eligible and both exclusively taxable supply and the common credit, entire amount put together, and they apply the exempted supply divided by taxable supply. So this Rule 42 is applicable only for the common credit. So it is not applicable for entire taxable supply. So we should educate them, sir. This is exclusively for taxable supply. It's 100% available. You don't want to apply this Rule 42 formula. You should identify these are all common credit and for which alone you should apply Rule 42. And likewise, even for Rule 43. So Rule 43 is related to capital goods. So the capital goods, what are all there? Sir, if you take a computer, then definitely it is used for both common. It's a common credit because we are billing both the taxable and exempted supply, POS and printer, and likewise furniture. So these are all comes under the common credit and it is also eligible ITC. And those common credit, this Rule 42 and Rule 43, we should apply. And ITC under reverse charge mechanism. So these company people will pay RCM, but whether they are availing as an input tax credit, that is a question mark. They are regularly paying reverse charge mechanism, but they failed to avail that money as a reverse charge mechanism. Sometimes there is an ineligible RCM they paid, but they claim as an input tax credit. What is their ineligible RCM? Yes, it is there. If the company is availing rent-a-cap, if the company is availing rent-a-cap, and rent-a-cap person, he didn't register under the GST Act. And when the company is receiving rent-a-cap services from those guys, the company has to pay tax under the reverse charge mechanism. So this software company is availing rent-a-cap services regularly on a monthly basis, and this company is paying GST under reverse charge mechanism. whatever he paid GST and the reverse charge mechanism, he is not eligible to avail the ITC because it comes under the 17 subsection 5, and under 17 subsection 5 it says it is the ineligible, it means blocked credit. So though they have paid under reverse charge mechanism, it is ineligible ITC. So those ITC they cannot claim. Then if it is advocate, yes, obviously they can claim. So because advocate fees, it is related to business. And if it is freight charges, that means goods transport agent, yes, it is eligible ITC, they can claim. So whether we should check whatever reverse charge mechanism they paid, they avail as input tax credit, and whatever input tax credit they availed under reverse charge mechanism, whether it is eligible ITC or ineligible ITC. If it is eligible ITC, definitely they can give, they can claim. Otherwise, they should reverse those input tax credit. And next one is reversal of input tax credit. Under which circumstances we should reverse those input tax credit? The reversal under Rule 37. The Rule 37 says 180 days of non-payment. What is the 180 days of non-payment? You have the assessee bought some goods from the vendor, and the vendor has given the bill. He filed properly GSTR1. He paid GSTR 3B also. So because of this, it is reflected in GSTR 2B. This guy is availed the input tax credit. But the invoice is already, the ITC availed in April month itself. But he still didn't pay to the vendor. Now it is September month. Whether he is eligible? No, he is not eligible. At least 190, within 190 days, he has to pay the GST. He has to pay the total amount to the vendor. If he has not paid, then he has to reverse whatever the input tax credit he already availed. And if he is not availed, if he is not reversed within 180 days, then obviously he has to pay under interest under section 50, and it is becomes payable. Sir, once he paid the tax, whether he is eligible for re-availment, yes, he is very much can re-avail those input tax credit once he paid the payment to the vendor. So some of the cases, some of the vendor, what happened, there is a litigation pending with the court. So because of this litigation pending, those people, they never pay to the vendor. So under which circumstances, better ask client to reverse those input tax credit. Once he reverses it, and any time he can reclaim if the litigation is over. So it is always better if any litigation part is there and litigation is pending before the court. So better ask them to reverse the ITC, and then they can reclaim whenever it is closed. So reversal under 37 for 180 days non-payment, it still is there. And reversal due to non-receipt of goods. Like 16 subsection 2, it says whenever the ITC available, if you have received the goods or services, it means I have purchased from vendor. Vendor issued tax invoices. He filed the GSTR1. He filed the GSTR 3B also. So it is reflected in my GSTR 2B in the month of April itself. But I didn't receive any goods so far. And I have received only in the month of June. So the credit which I have availed in the month of April, I cannot avail the ITC. So what I have to do, I should reverse it. Okay, then when I can reclaim, you can reclaim in the month of June. That is very much possible. So we should verify whether all the goods received or all the services received by the assessee. If they have not received, then they should reverse those input tax credit. And goods lost, destroyed, written off, or given as a free sample. So these we should verify. Section 17 subsection 5 is clearly mentioned, it is a blocked credit. Is there any goods lost, or is there any destroyed, or some of the goods has been stolen and they have applied for insurance claim, or during the course of manufacturing, that whatever the raw material will destroy, or sometimes if you take manufacturing of a company called pharmacy industry or any food industry, they have a lot of goods expiry based. So if those goods are food supply is already expired, then they used to write off. If they are writing off and whatever the input tax credit used for those material, they should reverse it. Because here the furtherance of supply test needs to be verified. So when you are destroying those goods, when you are writing off the goods, or when you are giving us a free samples to the customer, then there were no furtherance of supply is there, because you are not selling and you are not using. In that case, you are already consuming those goods. Hence, there were no ITC available. So here the block credit will be there. So how do we verify this? In the profit and loss account, we can check is there any goods written off, and if they have reduced the stock, or while going for the stock verification, is there any stock adjustments are there? And from there, is there any lost or stolen stock they have declared? And if those goods they have declared in the year profit and loss account, we should ask them to write off, we should ask them to reverse those input tax credits relevant to the lost of goods or stolen of goods or any destroyed goods. And most of the cases, to many people going for insurance claim, when they are going for insurance claim, and that time we can identify is there any fire happen, or is there anything happen to the stock. So that also, from which area we can identify is there any loss. So for this they should reverse, because it is a blocked credit, and they should reverse those input tax credit in the GSTR 3B return. And employee recovery adjustment. If the company is recovering some money from the employee, for example, the company is giving food to the employees. So when the company is giving food to their employee, and they are also recovering some money from them. For example, the employee is paying for 100 rupees for food, and he is receiving 60 rupees from the employee. And whether the company has to pay GST, whatever the money they received from the employee, no, mostly it is not, because the food cost is 100 rupees and they are collecting only 40 rupees, and the 60 rupees the employer is borne. So in this case, the GST will not come. Suppose the employee 60 rupees of food cost, for which the employer is recovering 100 rupees. Then the 40 rupees is a margin amount, and for which the company has to pay GST for which. So here we should check, is there any employee recovery is happening? Is there any is there any money recovered from the employee? We should just check whether GST liability will be coming or not. So in this case, we can easily identify while going through the ledger account. So from which we can verify whether GST has been collected, or if at all if at all they have not collected, we should check whether the GST leviable or not. And then input service distributor mechanism. So this one we know that a company, they have a 3 or more branches, and they want to distribute the input tax credit to their branches, and they have taken GST registration under the input service distributor. So this input service distributor mechanism, it is applicable only for the input services alone. It is not applicable for the input and capital goods. So here the name itself, input service distributor. So input service distributor means if the company receiving any services which is relevant to some other branches or many branches, then they can distribute those input tax credit amount through ISD mechanism. So here it comes like audit fees, consultancy charges, software subscription, advertisement expenses, which belongs to many branches. So this IST distributor will distribute those amount to their concerned the branches or concerned department, they will distribute. So this related only for the service area, and it will not reflected, it will not related for any other area called the goods or capital goods. And this one is a reconciliation with the profit and loss account, but critical check in profit and loss account. So we usually check a profit and loss account, but we usually check only for the sales amount. So what are all critical check we need to do? One is other income, whether the GST is applicable. So as I mentioned in the first slide itself, we have to concentrate on other income. Is there any consultancy income? Is there any commission income? Is there any rental income? Is there any service charges? For example, company has received a credit note, and in this credit note, it is relevant for the commission income. But the company, what it says, whatever he want to pay. For example, he is an intermediary person, the company name called P, and his vendor is A. His customer is Z. So P is a company, he is selling goods to the Z while ask A to send those money, send those goods. So what did happen? A directly supplying goods to the Z company, and A will directly A will directly billing to the Z company. In that case, this P company usually raising the tax invoices as a commission income, and then he will get the money from the A company. It usually happen. But some other cases, the P company will buy from the A company, and then P will transfer this goods to the Z company. In this case, suppose 1,000 rupees is a price, and he is selling same 1,000 rupees to this guy. But the A company will give 10% of discount to this P. For example, 100 rupees. And this 100 rupees, whether it is a commission income or whether it is actually a discount, depends upon their agreement. So we should verify the A and B between the sale agreement or commission agreement. We should check whether this credit note is relevant to the sale or it is relevant to the service charges. We should verify. And if it is related to service charges, then the GST will attract because it is a commission income. For avoiding to pay GST, they are receiving the credit note. So this kind of information we should verify through the agreement between those parties. And usually, whenever the company receiving the discount income from this company, from this vendor, so these discount, whether GST will be applicable, no, because the GST will not applicable for the discount because already he has given the credit note, which is already reflected GST amount. So for discount amount, again the company or the assessee will not pay any GST on this. But if it is related to any other commission income and they are showing as a credit note, then it will be a red flag. We should verify. So is there any consultancy income or is there any commission income or is there any rental income? The rental incomes are, but they didn't pay GST amount. And most of the proprietary concern people and those proprietary concern, they have a property. They have a commercial property as well as they have a residential property also. And they are running the business. They may running the business for 1 crore or 2 crore. And they are also receiving the rental income from the property which they have. What he will do, he will declare only the sales in the GST return. And he never said to us also, we have a rental income. And if he is receiving rental income, then in that income also we should add it in this case. And he may say, no, sir, for that the GST not there. This is my personal income and I cannot collect any GST amount. But in the proprietary concern, the PAN number is same. And we cannot say, sir, this is different and that is different. In this same PAN number, they are running the business income and also they are receiving the rental income. So once you receive the rental income in this PAN number, then GST has to be applied and you should pay the tax. So suppose I am a partner and my business is running in the partnership form. Whether am I liable to pay GST? Yes, but when it crosses more than 20 lakhs. If I am receiving only residential rental, whether I have to pay, no, you don't want to pay any tax because residential dwelling, it is fully exempted under the GST. So when you have given for the commercial, and if it is exceeding more than 20 lakhs, then you should collect the GST from the customer. But I'm having both the residential and the commercial. Then you put together, if your turnover crosses more than 20 lakhs, then you start to collect the GST for the commercial property alone. So the rental income, whether GST will come, yes, will come. So we should check under other income, is there any consultancy income, commission income, rental income, service charges? Not only that, scrap sales. So most of the cases, scrap sales, they never mention. Profit on sale of asset and profit on sale of machinery and profit on sale of motor vehicle. So these are all we can verify from the fixed asset schedule. We know, so under fixed assets, if any sales happen or if any removal of fixed assets has happened, we should check with them. Have you done any sales or have you write it off those assets or not? And suppose I am writing off some of the asset, the plant and machinery. I have a plant and machinery, and the life of the year under the GST Act, they are saying 5 years. So I am using one plant and machinery I have bought in the year 2022. But in the year 2025, I am removing this assets because it is outdated. So I cannot use this machinery. I have to buy another machinery because it's the new launch has come. So what I have to do, I have to write it off this machinery from the fixed assets. Here, what I have to do, you have to reverse the input tax credit for the balance 2 years because 2022 you have bought, so 22 and 23 and 24, then 25. So these 3 years you should reverse, you can avoid. The balance another 2 years of input tax credit, you are not eligible to avail since the assets is not going to use for the manufacturing purpose. It is already uh, outdated and you have already write it off from the fixed assets. Then you should reverse those input tax credit. So this we have to verify. And suppose if they are selling and what happened, this machinery, it is already 10 years old. But according to GST, it is only 5 years. So we already used to do 5 years and even another 5 years. And when you are selling after the 10th year, you receiving some money as a sale of asset. So whether the GST will attract, yes, it's like a scrap sales, we have to pay GST. So likewise, any sales will happen, and whether it comes under the scrap sales or it comes under the sale of asset or it comes under the sale of property, sale of a motor vehicle, then should check and then we have to apply for the GST payable. So this one is a sale of fixed assets. So machinery, vehicles or equipment, if anything is happen, then we should apply. And rule 44, we have to apply for the removal of fixed assets. When you are removing the fixed assets, then the rule 44 will apply and rule 40 also will apply. Then scrap sales. This scrap sales, scrap or waste material, it may be a metal scrap or backing material or is may be a defective goods. So some of the defective goods while manufacturing. So while manufacturing, some of the goods are defective or some damage. So those goods also we are selling to the market. So whether GST will be applicable? Yes, obviously will be applicable. So for which we should pay GST amount under scrap sales. And interest income. We know interest income is the exempted supply, yes. But some of the interest income, it comes under the penal nature. It means penalty nature. So when it comes to penalty nature, then GST will be applicable. So we should check this interest is related to money transaction or it's related to transaction of goods or services. So if it is related to transaction of goods or services, then it may GST leviable. So we have to go through the circular which has been released in the year 2023, and it may comes to around 12 to 13 pages of circular, and they have given and what rate you have to apply and when you have to apply and when you have to collect the GST for the penalty. So if it is penalty nature, the interest amount, if it is penalty nature, then it automatically GST will be levied, but may come or may not come. So for whom it is mostly applicable, mostly the government company, they used to collect interest income. If they are fails to give on a timely basis, timely delivery, or is there any terms and conditions, is there any misbehaving or misleading. So these kind of transactions, the government will collect the penalty amount. So for which penalty amount, the GST has to be paid by the government company. So this is the interest income. And subsidies and grants. So mostly the subsidies and grants, there were no GST will be leviable. But the thing is, the subsidy linked to the price of supply, then it may be a part of taxable value. It may be a part of the taxable supply is under say, so the taxation, the valuation under GST Act under section 15, they are clearly mentioned about how to how to avoid means how to identify is the subsidy is linked to the price of supply or not. So usually the government grant or government subsidy will not attract the GST and we should reverse those amounts. And trade discount. So this trade discount, as I mentioned in the earlier, so here the discount has given, we have a three type of discount. One is a trade discount. So the trade discount, whatever, when I am raising the invoice itself, I am giving the discount amount, then it is a trade discount. For example, if I am raising for 10 lakhs and I am giving 10% discount, so 1 lakh I will reduce. That balance 9 lakhs, for 9 lakhs rupees alone, I used to collect the GST amount, it's a trade discount. If it is a cash discount, I am actually sold to my customer for 10 lakhs. My customer is asking, I will give money now itself. You give me 10-20% of discount, then I will used to pay immediately. Then the assessee also agreed and he has given the 20% of discount. For this 20% of discount, we call it as a cash discount. Whether the cash discount we can adjust the GST amount, no. For cash discount, we cannot adjust any. We can give only financial credit note. We cannot issue a credit note which attract the GST amount. But there is another discount called post-sale discount. What it means, this post-sale discount? So there is a pre-definition or there is a pre-conditions between the vendor and seller. So if I am a distributor, I am a Samsung distributor, and now it is a summer season. So they have given target. If you are selling 2000 units of air conditioning machine from the period April to June, if you sold 2000 units from April to June, then I will give 20% of discount. And there is a documentation also they made or any some oral, there is some communication between the email. And they started to sell in the month of April, May and June. And they lastly achieved those targets. They sold more than 2000 units. Then the company will issue a credit note along with the GST amount. Whether it is allowed? Yes, it is allowed because it is a post-sale discount which is already, there is a preconditions between the vendor and the seller. So these kind of trade discount, however, they can issue within the time limit. So as I told you earlier, even any credit note, they should issue before 30th November 2000, I mean 30th November of subsequent year. Otherwise, whatever the credit note they have given after the time limit, it becomes a financial credit note and they cannot adjust whatever GST amount they already paid. And this one is a reconciliation of with balance sheet. And balance sheet, the critical check, one is advance from customer. As I told you earlier, if you go through the sundry debtors ledger and if at all any credit balances is available, and you can verify what is the credit balances, whether they paid the tax amount or not. And advances to supplies. So this advances to supply, whenever we are paying advance to the vendor, and that should be adjusted when we receive the bills and along with the goods or services. And is there debit balances? However, still it has not been adjusted. then we can verify whether the goods received or not. If any goods or services received, but still they have not adjusted, that's not a problem. But still they didn't receive the goods or services, then they cannot claim the input tax credit for the particular transaction. So we should check, is there any that kind of ITC availed by the assessee, so that we can verify through this. And ITC receivable balance. This ITC receivable balance under GST and as per our books of account, whether it is matched or not, we should verify. Because we may adjust the IGST for CGST amount and SGST amount, and CGST amount we can adjust for IGST liability. We will do it in the GSTR return. But in our books of account, we have only IGST credit, CGST credit, SGST credit. Sometimes the company will maintain single ledger for the entire things. So we should check the balance which is available as per GSTR 3B, means electronic credit ledger, and whether it is actually tallied with our books of account. If it is not, then we should check, is there any ineligible ITC available which is not reversed in our books of account. We properly reversed in our GSTR 3B return, but we may not reverse those ineligible ITC in our books of account. If you have not reversed in our books of account, then our expenses will be less. So the assessee will get the benefit of income tax. So under Income Tax Act, still it is comes under the asset, and that amount they cannot shown as expenses in their books of account. So whatever ineligible input tax credit they have, whether they also reversed in the books of account, we should check. And whatever eligible ITC they have, whether it is matched with GSTR 3B, that also we should check. So the balances matches the electronic credit ledger. And the credit is actually eligible and claimable, because in electronic credit ledger, all the credit, whatever it is available in the electronic ledger, only eligible, and it is also claimable. And some of the company, they are providing export of goods or they are doing export of services. In that case, they have applied for the GST refund. When they have applied for the GST refund, the input tax credit amount will be less, and the GST refund receivable only will be there. So in that case, whether the company has make that entries in their books of account, we should check. Otherwise, whatever the receivable amount, whatever the refund amount they have applied so far, it is always there in their credit ledger. It may be CGST or SGST, IGST, the same amount will be available in this ledger itself. So actually what happened, they should make a entry for the GST refund amount, how we have done for in the GST ledger, GST returns. So ITC receivable balance also we should check. And GST payable provision, so this we used to check, and we usually verify while filing the GSTR 1 and 3B, even while preparing our balance sheet, we properly verified this one, so that there were no problem here. An electronic cash and credit ledger, it should be tally. As I told you, if you have a cash ledger and if you have a credit ledger, it should be matched with your books of account. And special sectoral risk area. So what are all some special sectors and for which we should have a special attention? In construction real estate sector. So construction or real estate sector, we know from 1st April 2019 onwards, the GST rate is 1% and 5%. 1% for affordable and 5% for non-affordable, for which they cannot claim input tax credit. So they should reverse it. If they reverse and they also make a entry in their books of account, and they can claim as a expenses. This is for the residential real estate project. If it is not a residential real estate project, then it is a residential, it is not a residential real estate project means it may be a real estate project. Then the 18% of GST, it means 12% of GST is applies for the commercial construction. So if it is 12% apply for commercial unit, then they can claim input tax credit to the extent of commercial unit project. Sir, suppose if it is a residential real estate project and they are constructing commercial unit, whether they have to pay 12%? No. Even residential, even commercial unit, if it is there in residential real estate project, 5% of GST only applies. If it is a real estate project, then 12% applies for the commercial unit. For 12% alone, they can claim input tax credit. Otherwise, they cannot claim input tax credit for which. And 80% of procurement sold. So this is 9 subsection 4. So we know 9 subsection 4, it was active from July 2017 to 10th October, means 13th October 2017. Only these days was active. And after that, this was resigned. But again, from 1/4/2019, this 9 subsection 4, again, it is active only for the construction and real estate sector. So it means what? The company, the assessee has to pay GST under reverse charge mechanism when they are not meet 80% of purchases from the unregistered, purchase from the registered buyer. Say for example, if they are buying for 1 crore rupees, it's a purchase, out of which they should buy at least 80 lakhs from the registered buyer. Suppose if they are buying only 70 lakhs from the registered buyer, then for the balance 10 lakhs rupees, they should pay GST under reverse charge mechanism. So this 80% rule, it is applies only for the construction and the real estate sector. And ITC restriction validation, as I told you earlier. And if it is textile industry, so if you are a textile and a weaver sector, they have a inverted duty structure refund, because whatever they are buying as a material, it is a higher rate, and when they are selling as a finished goods, it is a lower rate. So they can claim inverted duty structure refund. So whether they are going for this, we have to verify. And is there any job for compliance? Suppose this textile industry has given any job work to somebody, whether they are filing ITC 04, that we should verify. This ITC 04, it may be a monthly, it may be a half yearly return or annual return. If they turnover more than 5 crores, then they should file half yearly return. Otherwise, they can file even annual return alone. And for exporter, so we know for exporter, the only thing is we should check whether they are going for with the payment mode and without payment mode. If they are going for with the payment mode, then that's not a problem. If they are without payment mode, then they should have a LUT. If they are not having LUT, then they cannot do without payment mode. And LUT validity, yes. So LUT they should file before doing the export of goods or export of services. And whether they have a foreign inward remittance certificate for receiving money from the customer. If they are not having the FARC certificate, we should ask them to keep it for evidence of the foreign payment remittance. And another thing, when we are going for a refund, we should submit this to the department. And this one is a new financial year readiness. So, so what are all we should be ready for the new financial year. So first thing is update the master data. So what is our master data? What are all HSN code or SAC code? So what are all product or what are all services we are dealing with? And for which, what is the HSN code and SAC code? We should given in our POS or we should given in our ERP towards raise the tax invoices. If any wrong tax rates has come, then it will be a problem. And we will receive the notices from the GST department. And is there any GST rate changes? So last year there was a change in the month of September 2025. There is a biggest changes in the GST rate. So whether they have applied those GST rate changes in their system, because they are raising the person who is selling the goods, they don't know what GST rate has to be applied. So we should change all the GST rate in the system itself. And e-invoice turnover threshold. We should go through what is the turnover they made in the last year, whether they have to or they are liable for issuing the e-invoices in the current financial year. So if their turnover crosses more than 5 crore, then they should mandatorily issue the e-invoices. So while starting our financial year, we should check whether they cross the threshold limit or not. If they cross the threshold limit, then we should tell them you have to raise the e-invoices. And LUT renewal, if they are an export company or if they are dealing with SEZ company, then we should tell them please renew their LUT. If without LUT, then they cannot do export of goods without export of goods or export of services without a payment. So LUT renewal, it is most important. And vendor compliance tracking. So that is most important because most of the vendor, they are not paying the GST amount and they are not filing their return. So before entering into the vendor or entering into the vendor contractual agreement or whatever it is, or before buying them, we should check the track record of them, whether they are regularly filing, when they took their GST registration, is there GST 9 and 9C filed for them, and they are filing GSTR 1, GSTR 3B regularly. So these we need to be verified. And after that, we may have a transaction between them. And the RCM tracking system. So we should give the list. So these are all services RCM will be coming. So if you are availing these services, then you should pay the GST amount for this under the reverse charge mechanism. So we should mention about these things. And compliance calendar preparation. So we give, there is a compliance calendar for filing of GSTR1. So this is the due date for GSTR1, and this is the due date for GSTR3B, and this is the due date for payment of tax. So, and this is the due date for GSTR9, and this is the due date for ITC04. These are all calendar compliances has to be given to the assessee so that it will help them, and we can also track them whether they have complied all the rules and provisions. And this one is final, and thank you so much for patiently hearing my session. And if you have any doubt, you please ask me.
Thank you, CM Manimaran Kathiresan sir, for the insightful session and for sharing valuable practical guidance. We will now open the floor for Q&A session. I request participants to please post their questions in the chat box.
Yashwanta, there are a few questions, which are posted by the participants. Can you
Yes,
take
sir.
one by one question? Can you read
Sure,
out for
sir.
the speaker?
Sure, sir. Mr. Kedarnath Potnuru is asking that he needs a clarification on ITC eligibility. Sir, need clarification on ITC eligibility. ITC on property management services like parking, CAM charges, water and maintenance, building maintenance services, bus rental, ITC on manpower like female staff work in canteen in an organization. Regarding this, is ITC is eligible or not? He wants to know this, sir.
Okay. So this related to canteen management or facility management, which is used for the business, then that's not a problem. They can claim. And if it is related to blocked credit, then it is purely ineligible ITC. And if it is used for personal purpose, then it is ineligible ITC. So for example, the company is maintaining gardening maintenance. Company, they have a garden and they are supplying people for garden maintenance. And it may be used to, this garden maintenance is according to the ISO certificate or whatever it is. Then that, even that expenses also, and they can claim input tax credit. But now the CSR activity, it is fully ineligible input tax. And previously, even we have paid for some CSR activities, the input tax credit was available, but now they removed. If any CSR activity you have done, done through by the company, then those ITC will be ineligible. So the thing is, what I'm saying, is there any statutory provisions, and according to this we are spending, and if it is used for the business purpose, then it's very much eligible.
Sir, there is another question. Nowadays, same from Mr. Kedarnath Potnuru. Nowadays, traders receiving the incentives from the suppliers, and the same incentives are subject to TDS under Section 194R. What is the GST impact?
Okay. So the thing is 194R, then it becomes again, it is a income they earned from the company. So it means already they declared as a income under the Income Tax Act. Okay. So this is the relationship between, for what is the problem is, it is related to that perquisites in business or profession. So it is basically any the companies has given incentive to dealers or distributor, or any pharmaceutical company given gift or travel to the doctors. So likewise, they are using this perquisites. So it is particularly, we can say, it is relevant to the business only. It means transactions between the company. So it is kind of services, and for which GST has to pay. It is also kind of services. It's equivalent to commission income.
Good evening, sir. My question is notice pay recovery taxable under GST?
Notice recovery received from the notice recovery. Okay.
Yeah,
So
yeah.
that notice recovery from the employees, it is not in the nature of services. So it is also here, it is not equivalent to penalty also. So this is already employment agreement. It is also during the course of employment. Then these for which GST will not be applicable. They used to adjust with their employee salary expenses.
Okay, it still should be reported as a turnover.
No, not required. Usually we should adjust with our salary.
Okay, sir. So it is not required to show it as an exempt turnover in GSTR.
No, not required.
Okay, sir. One more question is there. Sir, are soft copies of the invoices are enough to claim ITC, or we should maintain a physical set of invoices?
If the vendor has given any original tax invoices in a hard copy, you should maintain.
Okay.
It is according to GST Act, you should maintain for the 7 years.
Okay, sir. Okay. So
if they are not issuing the tax invoices in a hard copy, then you can maintain soft copy. That is okay. That's not a problem.
Okay, sir. Thanks. Thank you, sir. Thanks a lot.
Thank you.
There is another question, sir. Mr. Devish B. His doubt is, if an SEZ unit procures services that are covered under RCM, should the SEZ unit pay GST under RCM, or can the supply be treated as zero rated supply since it is provided to an SEZ unit?
Okay. So that the SEZ unit, whatever they register under the SEZ Act, to mean they have to get the GST registration is separately for the SEZ unit itself. So whatever the services received from them, if it is related to, if they are receiving advocate services, they should pay GST and they can claim. So there were no separate exemption for them for the SEZ unit. They can claim. For example, if I am supplying any services or goods to the SEZ unit, and when I am supplying, if it is relevant for the, means for example, principal goods or services to the industry, then the zero rated supply will be applied. Otherwise, if anything else, then there were no zero rated supply. We should collect the GST from the SEZ unit. There were a huge amendment was there. So likewise, if they are receiving any RCM related services, they should pay and they can claim as a refund. So they have a refund facilities is available for them.
Sir, good evening.
Yes, sir.
Yeah, good evening. Sir, please.
Sir, really, it was a wonderful session, sir. Really, you covered a lot of topics, and it's really insightful to all of us.
Thank you, sir.
Wonderful, sir. Sir, my question is, ITC on the property management services like a parking, camp charges, water, electricity, all these things like a big commercial complexes. Like let's take a big commercial complex where the software companies they operate. So the common area maintenance charges they charge. Like it's a 10 lakhs rupees. Let's say per month it might be 10 lakhs rupees for the common area charges and everything. They charge a GST at the rate of 18%. Now the question is when they issuing the invoice, they mention as a SAC code is 995419. Now why I'm getting a doubt the eligibility of ITC because 9954 it is coming under a works contract similar type building related thing, right? Now the thing is how to interpret this SAC code and the eligibility of the ITC.
So whether they are providing AMC services or construction services means they are collecting for that maintenance services or they are doing construction services.
It's a maintenance only, sir.
Okay, they are collecting only maintenance. It's like a residential association unit. Likewise, you are saying.
No, it's a commercial. I mean to say about let's say ABC Private Limited is a software company, which is there in a big commercial complex, which is maintained by the Phoenix. The company college, they're maintaining, they're collecting this maintenance charges like a parking charges, like they call it a electricity charges, water
so
charges.
you are saying that for the commercial, whatever the rental given by the commercial unit, they are collecting the these charges from the software company.
Yes, exactly, sir.
Okay. So what you are asking whether it comes under the works contract services or it's a maintenance services. It is comes under the maintenance services, not comes under the works contract services. It is actually rental and maintenance. So rental charges is separate and maintenance charges is separate. And for maintenance charges, they used to collect 18% of GST and they can claim input tax credit whatever they pay.
So that ITC is eligible.
Yes, yes.
Right, sir. Got it. Sir, one more question. You touched upon regarding the refund. We filed the refund application, and as on 31st March, we did not receive the refund. So, how to disclose that amount in the balance sheet?
Okay, that is we can say as a refund receivable.
Simply
refund receivable under the T, which is already available in the IGST credit or CGST credit or SGST credit. So in which we suppose say for example you have applied for 1 crore as a GST refund and 25 lakhs from CGST, 25 lakhs from SGST and 50 lakhs from IGST. It was there in the CGST, SGST, IGST balances. So what you have to do, you have to reverse from this and you have to keep it as a GST refund receivable. So same effect, only credit and debit, that's all.
Oh, it's in a okay. Means earlier ITC receivable one had earlier. If in case the refund is there, means we have to bifurcate the entire amount into two parts. One is ITC receivable. Second one is refund receivable.
Refund receivable. Yes, yes.
Okay.
Because if you are checking with your ITC ledger, it will not be tally because it's already applied for refund receivable and refund, and that amount will be debited from the work credit ledger.
Okay. So even irrespective of whether it is with payment or without payment, the ITC is already gone to the department.
Yes. Yes.
So we have to report in the ITC receivable.
Yes.
It's a refund receivable.
Yes.
Sir, one more question, sir. Shall I?
Yeah, yes, sir.
Sir, in one of our clients' case, the concerned accountant failed to raise a e-invoice. E-invoice is applicable to them, but they have done export of services with payment. But they done manually. They done export of service manual invoice. They have raised it and they paid the IGST amount in the 3B also. So will it create any problem?
So usually they will charge a penalty. It's a general penalty because of procedural lapse.
Okay, sir.
But it won't affect your GST refund. It is only procedural lapse because it's the export is already done. So you need to verify that the export is already happened. And I have also received the foreign currency from the company, and for which I have FARC certificate. You should submit, and I have also LUT. So whatever it may be. So the thing is, because of I'm not raising e-invoice, whether it affects the GST, no. GST refund, no. It is only procedural lapse.
Okay, sir. Got it. Clarity. Thank you, sir. Thank you very much.
Thank you.
There is another question, sir. Mr.
Yes, sir.
Ramesh, he
Ah.
would like to know, could you please explain GST implication in case of joint development agreements?
Joint development agreement, what they need?
GST implications, sir.
GST
In case of
implication. Okay.
yes,
Okay.
sir.
Okay. See, when they are entering into joint venture between landowner and builder, and it is related to promotional, so real estate promotion. So the thing is, a landowner as well as a builder, they will both are become a promoter under the RERA and also under the GST Act. So suppose the landowner agreed, sorry, the builder is agreed, if they are going to construct the 8 flat unit, and the builder agreed to give 4 units to the landowner and 4 units to the builder. The thing is, the builder has to collect the GST for entire 8 flat, will not will not for only 4. So even though they have given 4 flat to the landowner, he should collect the GST amount from the landowner also. So what he has to do for entire 8 unit, he has to collect 5% of GST if it is non-affordable. If it is affordable, 1% of GST from them. So they should collect the GST and he used to pay the tax. This one. And usually the landowner will argue, this is my place and this is my land. And because of I am giving land, you are constructing, I will not pay. But this is not correct. The act says he has to collect the GST amount, because when we are entering into the agreement itself, it becomes a works contract. So construction contract, it starts. So when construction contract starts, then the landowner has to pay GST to the builder. This one first part. And the second part, he cannot claim any GST because he is paying the GST amount under the concessional rate. Whether he can opt to pay 18% of GST, no, because it is not a construction, it is not a works contract. It comes under the construction contract, means real estate promote. The two. And third, if I am a landowner, I am receiving 4 unit and I am not going to use it entire 4. I am going to use only 1. The balance 3 I am going to sell to the customer. Then whether am I eligible for input tax credit? Yes. Whatever the builder is collected GST amount from me, I can adjust that GST amount as ITC when I am selling to my customer. So this is possible only for the landowner and not for the seller. Then fourth, suppose is there after completion there was a unsold units are there. If still unsold units, suppose out of 8 we did all the construction, but I cannot sell balance 2 unit, but the entire 6 units was sold out. The balance 2 units alone, if it is still pending, then the builder has to pay GST under reverse charge mechanism only for this 2 units, not for the entire 8 units. So this 2 units, if it is a residential flat, then he can pay 5%. That's all. This 4 condition he has to follow if they are entering into the joint development.
Sir, the
Yeah.
same person is asking when we need to pay the tax.
When he is handing over.
Okay, sir. There is one more question left, sir. That is from Mr. Devansh B. He need to clarify. I have one more doubt. If a consultant is providing services to our SEZ unit but does not have an LUT, either because the consultant is unregistered or is registered but has not applied for LUT, what potential issues could arise in such a case?
Oh, one more time you tell me.
If a consultant is providing services to SEZ unit but does not have an LUT, either
Okay.
because he didn't apply for the LUT or that particular consultant is not a registered person, then
Okay,
what
fine.
will be the potential issues?
Okay. If it is a consultancy services, if it is not related to goods, if it is a consultancy services, even if he is not registered under the GST Act and he is eligible to supply till threshold limit of rupees 20 lakhs. So till rupees 20 lakhs, if he is supplying even SEZ unit or means IGST unit or even interstate sales, there were no liability to pay tax. It is not like goods, because for goods only interstate supply is mandatory to register under the GST Act, even the threshold limit does not crosses. But for the service provider, that's not a problem. However, if they crossed their threshold limit, then they should register under the GST Act, and without register the GST Act, they cannot sell those goods. And second thing, if they are not applying the letter of undertaking, then what happening? They should pay GST at 18%, because of they are not applying the letter of undertaking, then they are not eligible for the zero rated supply under the GST Act. So for zero rated supply, there is a condition, they should apply letter of undertaking. For payment, suppose if they are selling to SEZ unit with the payment mode, then there were no problem. Even without LUT, they can sell.
There is another question from Devansh B. Sir. With regards to my earlier doubt on RCM, will the same conclusion also be applicable for imports made to SEZ unit?
Imports made to SEZ
Imports.
unit.
Yeah.
For import of services, RCM will be applicable for the SEZ unit. For SEZ unit, there were no specific exemption given. So they have to fall under the reverse charge mechanism. They should pay under reverse charge mechanism and they have to avail the refund. That's all.
There is one more question, sir. ITC receivable balance should be reported in the balance sheet. Is after filing March 3 be written or on 31st March?
Receive the
ITC receivable balance should be reported in balance sheet. Is
Okay.
after filing March 3 be written or up to 31st March?
Okay. See, actually that we are filing our GSTR 3B return only in the month of 20th April 2026. But as per our books of account, we will close it 31/3/2026. However, we can adjust the sales liability. It means the GST liability, which we can adjust with our GST ITC. So even after 20th April, we come to know what is the exact balances is available. So the thing is, we know what is the GST liability and we know what is ITC we have and the balance money what we need to pay. So whatever money we need to pay, suppose we have very less amount of input tax credit and we have a liability to pay by paying cash, then that money should be available as a GST payable. That's all. So usually what we do like TDS and provision for taxation, what we will do, we will make a provision for taxation and it will be available in our balance sheet as a credit side. And after the April, we used to check whether those money has paid. So likewise, we can also verify here. So the 20th April, we can verify what is the payable, whether they paid or not. That's all.
Sir, there is one more question, sir. My client is in a construction industry. He is telling GST is payable on advance, but ITC can be claimed later when purchase is made. And the rate is 18%, making it difficult to do business. Even we can't claim any input on diesel charges, which is not under GST. So is there any relief for those people?
Okay. So that whenever we are receiving the advance amount from the customer for the service rendered, then we should pay GST. So it is mandatory provision. And you can do, only thing is you can do, we can treat as a inclusive of GST amount. Instead of, if you are receiving a 10 lakhs amount as a advance amount, then you cannot apply directly from 10 lakhs into 18%. Instead of that, you can consider 10 lakh is inclusive of GST, because the customer will not pay GST amount for the advance money what he has paid. So you always consider whatever advance money received from the customer is inclusive of GST, and then you pay to the government. So it will not affect your workflow. That means work in progress. And the next question were even we cannot claim. So okay, that for diesel, yes, we cannot claim because it is a non-GST leviable. And the thing is, whenever we are paying the GST amount on 18%, you can very much claim input tax credit, but it is related to GST. For example, if you are purchasing cement, if you are purchasing steel, and if you are purchasing electrical item, which is used for the construction of these items, then you are very much eligible to avail the ITC. But non-GST leviable, exactly you cannot claim.
Thank you so much, sir. There are no more questions. And before the conclusion of the session, I would like to tell that it's such a wonderful session, and thank you so much for your time and knowledge. I also like to thank all the participants for joining us today. Thank you. Have a great evening.
Thank you so much. Thank you
Thank
very
you.
much for the. Thank you so much for inviting me. Thank you very much for all the participants. Thank you.